In that vein, I know your testimony touched on concerns with regard to the national debt. Could you elaborate on that and how it should be addressed, particularly as it relates to expanding or at least not contracting the economy?
So I think it's a longer-term issue that I imagine we all realize will have to be addressed over time. It's just the case that now that the debt is growing faster than the economy, than the nominal GDP. And ultimately, in the long run, that's not a sustainable place to be.
Now, there is the outlook that people have that, don't worry, no matter how much debt the United States takes on and no matter how much they're spending, the United States dollar is still the reserve currency of the world, and it will maintain that. We do know that that is maintained through the industrial military complex defending the US dollar at all costs. At all costs. But we're seeing some interesting things happen, right? What are we seeing? The status as the global reserve currency is slowly fading away. Is that possible that could happen? We're looking at here from the IMF, the share of US dollar global reserve currencies dwindling. And is that correct? That's from the IMF. Let's check that out. And we could dig in a little further and see. If you look at these graphs over here, you can see that the United States, the US dollar currently has a 61.63% of all reserves. But what's happening here with the euro? What's happening here with the yen? They're both growing. They're getting a bigger piece of that pie. Things happen first slowly and then suddenly. But it's happening. You have countries like Russia, who's diversified all the way out of US treasuries. Japan and China are also selling off treasuries. And we see that the US dollar share of global currency reserves is at a 6-year low. What is happening? What is happening is the United States has used the dollar as a weapon, imposing sanctions on countries such as Russia and Iran, and people are scared. They don't like it. If the US is not playing fair, the other countries need to prepare, because reserve currency status doesn't last forever. We have things like Bitcoin making a nice move to the M1 monetary supply, and it looks like within another 5 years we'll have overtaken the US dollar. Right now, Bitcoin is the 11th largest currency as far as M1 supply. Within another 18 months after the halving, it's expected that this will be the top 5th. Although countries like China and Germany and Russia are aligning, does that mean anything? Well, China is the biggest economy right now. And then you have also Russia and Germany are pretty big economies. And they're all aligning. They're aligning and working towards diversifying out of the US dollar. And what does that mean? We had Federal Chairman Powell meet with President Trump the first time since February, and this time they met in Trump's personal quarters inside the White House. What's going on? Let's dig a little further.
President Trump meeting at the White House with Fed Chair Jay Powell. Trump tweeting out after that meeting that they discussed interest rates and negative interest. Important.
It was the first such meeting between the president and the nation's top policymaker since at that informal dinner, you might remember, last February.
Having first described the meeting with Fed Chair Jay Powell as good and cordial, the president took to Twitter last night to return to form and complain about monetary policy. Here's what he said. At my meeting with Jay Powell, I protested fact that our Fed rate is set too high relative to the interest rates of other competitor countries. In fact, our rate should be lower than all others. We are the U.S. Too strong a dollar hurting manufacturers and growth. That statement lacked the name-calling and over-the-top criticism of the Fed from the president's other tweets, so perhaps the face-to-face meeting had some modest impact here. The Fed had said in its statement earlier today, yesterday, Chair Powell's comments were consistent with his remarks at his congressional hearings last week. He did not discuss his expectation for monetary policy, except to stress that the path of policy will depend entirely on incoming information that bears on the outlook for the economy. Powell's been pretty clear that the Fed is not at this point going to reduce rates in order to target the dollar. Officials have said rates are higher because, as the president himself has argued, the U.S. economy is far stronger than in Europe. And
now President Trump has threatened, once again, higher tariffs if China doesn't make a trade deal. And this looks like he's posturing. This looks like he's trying to put a little bit of pressure onto China to go ahead and get a deal. But what we also learned is that the U.S.-China trade deal, the phase 1, is being tied to tariffs being taken off is being tied to that failed deal in May, when Premier Xi walked away from the trade deal, walked away from what they had worked out at the last minute, and then Trump went ahead and escalated the situation. They have to return to what was worked out in May 2019 in order for the tariffs to be released. Otherwise, the December tariffs are going to be put on. So what was this meeting between Trump and Powell all about? This meeting that took place in Trump's personal quarters. Was Trump preparing the Fed chairman that perhaps the China situation may escalate further in order to prepare the Federal Reserve to give him a heads up? That's what looks like it's happening to me. It doesn't look like China's in any rush to go ahead and bend the knee. China's looking to stick tough. They know that President Trump is currently having impeachment hearings. He has an election coming up. If he doesn't get reelected, they're going to have their cake and eat it too. So they might be playing a little bit hardball. This is going to force Trump's hand. It's going to force him to go ahead and raise tariffs in December. Trade accordingly. Be aware. This is what looks like it's developing. Now, this also could be posturing in order to put pressure onto China to go ahead and make this phase one deal. We're going to find out shortly. But either way you look at it, the world's two greatest superpowers are battling out. This is not just a trade war. This is a war for the future. And sure enough, with these ongoing trade tensions, China is discreetly de-dollarizing. The ongoing trade conflicts have forced China to increase its financial decoupling between the U.S. and wants to decrease its U.S. exposure. This is coming from economists at an Australia and New Zealand banking group called ANZ. The ongoing trade war and geopolitical issues have increased the risk of financial decoupling between China and the U.S. They predict that Beijing will quickly diversify its foreign exchange reserves away from dollars. Although China still allocates a high share of its FX exchange reserves to the US dollar, estimated at around 59%, they predict Beijing will quickly diversify its foreign exchange reserves away from dollars, and that the process of diversification to other currencies will likely quicken going forward. They stated they see China diversifying into British pounds, euros, Japanese yen, and of course, gold. ANZ believes China is building shadow reserves as a way to diversify away from the dollar. Now, China has spent the last 6 years reducing its holdings of U.S. treasuries. And although the dollar is the world's reserve currency, ANZ Group does warn that it could be displaced in the coming decade. Efforts of de-dollarization by China could reduce the world's reliance on the dollar by 2030 and at some point catapult the renminbi into the hot seat, because we know that reserve currency status does not last forever. This is a lot more than a trade war, and there's a lot at stake.
But Damien, the fact that the market has reacted in the way that it has must indicate that the market at least believes that to a certain extent this pressure is having an effect.
Well, I think what the market's probably thinking is that Trump is applying as much pressure as possible for the Fed to continue cutting rates to stimulate the U.S. economy. And so I think that's why the dollar probably is coming off, at least initially here, because lower yields means a weaker dollar, I think, Guy.